My name is Jeffrey Jones, and this is my Bloomberg analysis project for Finance 451, Fall 2018. So our goals for this project is to analyze 5 companies from one industry, picking the highest from performing from the industry and writing a sell-side report for that specific company. The industry that I chose was the defense industry. The reason why I chose is because you don't really hear a lot about this industry compared to the other ones such as construction, medical, and oil and gas, and healthcare and stuff. And then also I didn't know too much about a lot of the companies in this industry. So I'm using this obviously as an opportunity to learn more about these companies in this industry as well. So the defense industries that we're looking at, the top 5 are the United Technologies Corp, the Raytheon Corp, Lockheed Martin Corp, Northrop Grumman Corp, and General Dynamics. And so for this project, we're going to go back and forth between Excel and PowerPoint. So you just kind of have to bear with me. We're going to look at kind of the charts in Excel and then look at the graphs in PowerPoint. So first thing we're going to look at is kind of short term. So we're going to look at some cash ratios, current ratios, and quick ratios for each company. And just kind of going over these. Remember, we want our cash ratios to be high but not too high. We prefer them not to be over 1. Current ratio, we'd rather a low. That means that there's a strong operating cash flow. We don't want it any higher than 2. And then our quick ratio, we want it low. We don't want it too high. So we're going to switch over on to the chart and look at the companies. I'm going to try to go through these as quickly and efficiently as possible. So looking at United Technologies, first thing we're going to look at is the cash ratio. So over the past 5 years, we've seen steadily increase, which isn't bad at all, because like we said, we'd rather this be high than low. So that they're increasing, that will definitely be good that they're increasing over the next years to reach a higher ratio. Looking at the current ratio, we wanted it low. We didn't want it higher than 2, and as you can see, none of these are higher than 2, so that's good. And then our quick ratio, we want it to be low. We didn't want to be too high. These are a little higher than some of the other companies that we'll look at, and it's increasing, which isn't always the best sign. So going on to the Raytheon Corp, again, we have a company that's slowly decreasing, which again, that's not necessarily bad. Obviously, our cash ratio, we'd rather high, but not above 1. For our current ratio, as you can see, it's slowly decreasing, which is good because we'd rather lower rather than higher. And then our quick ratio, we'd rather lower, and as you can see, this one's slowly decreasing, so that's good as well. The Lockheed Martin Corp, again, cash ratio, it's low, but again, that's not a bad thing. It just means that, we don't want it too high because that means it could be wasting valuable resources or cash and not putting it into good use. So that it's low is not a bad thing. The current ratio is also low. It's closer to 1, which is what we would like to see. And our quick ratio is low. Again, the only thing I worry about this one is over the past 2 years, it's definitely shot up a significant amount. So it's definitely something that we would like to pay attention to. Northrop Grumman, again, the only one issue with this one is we had high, then we started to decrease, and then in 2017 it shot above 1, which we do not necessarily like to see. Current ratio, obviously with this one shooting up to above 1, we're definitely going to see an effect as we look at the current and quick ratio. Current ratio was good, again, until that it shot above 2, which we don't necessarily like to see that. The quick ratio, same thing, shot above 2, and we'd rather that be on the lower side. So that's definitely something that could bring a concern for the future. It'd be interesting to see how they perform in 2018. So looking at General Dynamics, definitely low cash ratio, which is good. Current ratio, definitely on the lower side compared to some of these other ones where they're at like 1.5, 1.6, a little higher. And then quick ratio, same thing, low, which is definitely good. And they stay pretty consistent as well. So switching over to the PowerPoint, we're going to look at the chart again. That's kind of just breaking it down more easily to see. And then we're looking at our graphs. The red is UTXO United. The orange is Raytheon. The yellow right here is Lockheed Martin, and green is Northrop Grumman, and General Dynamics is the aqua blue color. So as you can see, most of these companies are pretty consistent. They stay within a specific range, except for this one right here, the Northrop Grumman. Current ratio, same thing. All these companies stay pretty consistent with each other, slowly increasing, slowly decreasing, except for Northrop Grumman. Next thing we're going to look at is profitability. So we're going to look at, sorry about that, some return on assets, return on equity, profit margin. But before that, real quick, I just wanted to go over the financial leverage for each company. On financial leverage, we'd rather low than high. United Technologies, we stay around 3, which isn't bad. Raytheon, we're staying 2s. Increase in the last year, 2017. Again, not bad. Financial leverage, Lockheed Martin is kind of high, which we'd rather be low. We're looking at like 15, 8, 13, 21, and then in 2017 it shoots up to 113 or 113.92, which is a little question for concern. Be interesting to see. Do some research and see why exactly that happened. Northrop Grumman, we're looking at 2s, 4s, so it goes a little higher over the years. But again, we saw some issues in 2017, so that's obviously why that has been occurring. And then with General Dynamics, we're at low 2s, low 3s, which is pretty good. So we're going to go to profit margin. Profit margin, we'd rather it be low. Low meaning that there's a low margin of safety when it comes to profit margin. So United, we're looking at around 10 to 13, then 8, then drops down to 6. So it's decreasing, which is good. Like we said, we'd like to see it low. Again, with Raytheon, we're looking at 8, 9, 9, 9, and then drops to 7, which is good. It's a decrease. Lockheed Martin, we're looking at 6, 9, 8, 11, and then drops down really low to 3, which is good. Northrop Grumman, we're looking at 7, 8, 8, 3, and 7. And then General Dynamics, we're looking at 7, 8, 9, 8, 9. So staying pretty consistent. Looking at return on assets, we'd like to see an increase in the return on assets. Looking at United, we're looking at a decrease over the past 5 years. Raytheon, we're looking at kind of a decrease as well, but staying fairly consistent in 2 points of each other. Return on assets for Lockheed Martin, we're looking at an increase, and then a quick drop. Again, we had some issues up here with the financial leverage. Northrop Grumman, let's see, with return on assets, it was stayed pretty consistent, 7.3, 7.8, 8.7, then dropped to 6.6. Again, we like to see an increase. And then return on assets for General Dynamics, we're looking at 6 to 7 to 9 to 7 to a little higher, 8, so increase as well. Next thing we'll look at is return on common equity. And this is, we like to see this high, but this doesn't always mean that it's a good investment. A lot of investors will tell you return high on equity is good, but it's not necessarily always the case. So this one, return on common equity for United, 19, 19, 25, 18, 15. So pretty good, but it's dropped a little, so it could be a little concern. 20, 21, 21, 22, 20. So it was increasing, fairly stable, and then kind of dropped down a couple of points. For Lockheed Martin, we're looking at 120, 86, 110, 230, and they didn't have any data for 2017. But you can look at that, and a lot of people look at that and like it because it's high. But again, that doesn't necessarily mean that it's a great investment. Because again, we did run into a few issues with this one, the financial leverage and stuff. Northrop Grumman, 19, 23, 31, 40, 32. So we were increasing, then we dropped. And we had a good jump from 15 to 16, and then a good drop from 16 to 17, which could bring some concern. And then General Dynamics, we're looking at 18, 19, 26, 24, 26. So we had a good jump from 14 to 15, then it kind of dropped a little and then went back up. So that's always a good sign when it's going up and increasing and not decreasing. So next thing we're going to look at, let's see. So again, here's some of the graphs for these companies, looking at profit margin, return on assets, and then return on equity. Next thing we're going to look at is some market value, so price earnings, market to book, things like that. So we're going to go back over here to Excel, price earning. So investors like to see this high because it shows a lot of room for growth. So this one we're looking at 19, 17, 15, 17, 19, which increased, then decreased, then increased. So it's good that it's increasing. I like to see that. So for Raytheon, 14, 15, 20, 20, 24, so slowly increasing, so that's really good for investors, I'll tell you as well. This one 15, 19 for Lockheed Martin, 20, 20, 24, so increasing, so that's good. Northrop Grumman, we're looking at 13, 15, 18, 19, 24, so increasing, so that's not bad at all. And then for General Dynamics, we're looking at 13, 17, 14, 19, 20. So we had a decent jump from 2013 to 14, then it dropped a little, then increased a little, and then a little increase. But remember, a little increase is better than no increase at all. And the last things we're going to look at is the price to book ratio. Below 1 is good, but anything under 3 is not bad. So looking at United, we're looking at 3, 3, 2, so it dropped below 3, but then went back above 3, which is always great. This one, 2, 3, 3, 4, 5 for Raytheon. For Lockheed Martin, 9, we're pretty high up here, 9, 17, 21, 47. That could bring some concern that it's so high. Northrop Grumman, 2, 4, 6, 7, 7, so slowly increasing. General Dynamics, 2, 3 to 4 to 5 to 5.28. So it's an increase, but it's definitely slower than Lockheed Martin up here that jumped from 9 to 17 to 21 to 47, and then no data for 2017. So again, this is kind of breaking down some of the price to earning, market to book companies. Here's a graph for market to book, price to earnings. So the one that I'm going to write the sell side report on that I felt was the best investment to choose would be General Dynamics. And the reason why is overall it had the best ratios consistently. It may not have had the best in every one, but overall I felt like it did pretty well, and it kind of stuck to the standards that we had set as far as looking at cash ratios, current ratios, price earning, profit margin, things like that. So I'll be writing my sell size report on General Dynamics.